go time.
Good morning and welcome to the Next Level Mortgaging Podcast. My name is Todd Martin, your host from Mission 35 Mortgages. This week I thought we would talk a little bit about the Bank of Canada rate drop from June 5th, from 5% down to 4.75%. Their talk of dropping another quarter point at some point this year, probably next month, and the possibility of another one throughout the year. I'm thinking probably November. So the possibility of going from 5% down to 4.75 or 4.25 by the end of the year. What it means for you, what it means for your mortgage, what it means for different mortgages, and how it can help you in the future. Immediately, if you have a variable rate mortgage right now, it means your interest rate will drop right away because your variable rate is connected to the prime, which is connected to the Bank of Canada rate. So prime rate prior to this was mostly around 7.2%, meaning it will drop down to 6.95%, and your interest rate is most likely prime minus whatever, prime minus 0.9, prime minus 0.75, prime minus 1.1. Those are, usually around what most interest or most variable rate mortgages are. And by dropping that rate, meaning more money that you pay on your mortgage will now go towards your principal again. And as the rates drop again and again, hopefully throughout this year, as long as we maintain, solid inflation rates and unemployment doesn't maintains its numbers, and our general status with our economy is solid, we will maintain where we are and drop our rates throughout the year. Those numbers will continue to come down for you. So those are good for variable rates that are in existence already. For future rates, also good news. Variable rates will be directly affected, will come down automatically. Best rates out there right now, prime minus 5-year, prime minus 0.95, 3-year, prime minus 0.71%. So immediately, like I said, we are at 6.95 on the prime rate minus, whatever you're going to find out there for the minus rates. So those are good things to see in the future. What does it mean for a fixed rate mortgage? Well, these are more complicated because the Bank of Canada rate does not directly affect the prime rate or your fixed rate. Fixed rates are affected by bond yields and bond futures, and the bank buying and selling government bonds. So will it affect it? Yes, because if the bank sees the future, if there's more solid numbers coming from the Bank of Canada and the interest rates are coming down, they're going to see better yields from those bonds. And if they see better yields from those bonds, that means the spread between the bond yields and the fixed rate mortgage yields, fixed rate numbers are going to shrink. And as that shrinks, the fixed rate numbers come down. Those are all good things. It doesn't happen as fast or as consistent as, the numbers don't work the same as they do with the variable rate. You're not going to see, if you had a rate hold of 4.99, you're not going to see it drop to 4.74 because the rate dropped a quarter point. We saw some numbers come down over the last week. I saw some numbers come from 4.99 down to 4.89. Some 3-year numbers come down from 4.29 to 5.29 to 5.14. So we have seen some effect out there from this Bank of Canada rate, but it will fluctuate back and forth because people will see reaction to this, and that will change the yields again, and we'll see some people hold on stuff. We'll see a little bit go up, we'll see a little bit go down. As the number comes down steady and we see stability with that, that will create a more stable future for the bond yields. And as that future is steady, they will be more secure in the ability to tighten that yield difference between the two, and that will see a drop in the rates over the future. So it's going to take time, as everything in this industry. The last time we went 5 to 2%, it took a decade. I don't think it's going to take that long. The government, Bank of Canada, said their goal is to go back down to 2% eventually. It's not going to happen this year. It's not going to happen next year. Is it going to happen in the next 5 years? That's hopefully. But again, it's all going to depend on how the economy reacts to the drops we're doing right now. If the drop happens in June, the drop happens in July, and the economy doesn't react well, inflation goes up and the economy takes a hit, we're going to see the rates at least hold at this point and steady itself again for another 6 months. Again, this is all a learning curve for us right now. We're going to have to wait and see what happens. None of us have been through a pandemic like we have, where things skyrocketed and plummeted the way it did. It's going to be a reactionary period. We're going to have to wait, see what happens. Bank of Canada is taking its time. So take the good news that's out there. If you have any questions at all, you know where to find me. I really appreciate if you hit that like and subscribe button. Come find me if you have anything. Have a good one, guys.